Good morning, everyone, and welcome to today's class called Basis of Assets. This is a pretty important topic and a topic that often confuses people, especially our tax clients, but also all too often tax preparers themselves. So we're going to spend lots of time going through all the intricacies of figuring out the basis in assets. And we're going to begin on page 2 of the manual with an introduction. And this is essentially a description of my own summation of the meaning of basis of assets. It's not like the IRS definition. It's just how I tend to think of it. Basis is the amount of after-tax cost or investment that you have in property for tax purposes. Basis is used to figure deductions you are allowed to claim for depreciation, amortization, depletion, and casualty losses. The basis of property is used to figure your gain or loss on the sale of property. And if you sell a capital asset, then the sale of that asset is generally reported on Form 8949 and on Schedule D. Today's class is not a class about selling assets, so we're not really going to be spending any time focusing on 8949 and Schedule D, but it's pretty hard to talk about basis of assets without referencing those forms. So I will come back and forth to them a little bit, but without ever really giving an in-depth lesson on how to complete those. And the reason for that is those forms are covered in detail in other courses in our curriculum, that is Pacific Northwest Tax School's curriculum. And we'll actually be covering sale of assets next week in our CPE series. So let's look at a definition for capital asset. We're just covering some definitions here because as you're reading through IRS rules and reading publications, it's important to have in your mind what the IRS is thinking of when it defines a particular phrase. And right now we're looking at IRS's terminology for the word capital asset. The tax code says that all assets are capital assets except when they're not. So let's look at when they are not capital assets. And the wording here, of course, says all assets are capital assets unless they are one of the following. And this list comes from publication 17, page 106. Assets that are not capital assets include stock or inventory held for sale to customers, accounts or notes receivable acquired in the ordinary course of a trade or business, depreciable property used in a trade or business, real property used in a trade or business, copyrights, literary, artistic, or similar property created by personal efforts or acquired from the creator under circumstances that entitle you to the creator's basis in the property. And finally, U.S. government publications that are free, like Pub 17, for example. Now, all of the following assets are capital assets, and they include personal use property such as dwellings, that is your home, cars, furniture, jewelry collections. Even your pet cat technically is a capital asset. Investment use property, land, stock, municipal and corporate bonds, collectibles, antiques, etc. And business use property, but only certain intangible personal type property such as goodwill or franchise, plus any net Section 1231 like-kind exchange gain from the sale of business use assets. Now, as I said, in a later class, we're going to be getting into the intricacies of selling assets and the reason why these definitions are important. Ultimately, the reason why these definitions are important is that if you sell a capital asset, the sale is typically reported on Schedule D in Form 8949. And if you sell an asset that is not a capital asset, because it's a business asset, for example, maybe a depreciable asset like an office building, when you sell that, that sale is not directly reported on Schedule D. It's actually reported on 4797. So assets that are, the sale of which are reported on 4797 our assets are typically referred to as assets that are not capital assets. But assets that are not capital assets can also include inventory, and you don't report the sale of inventory on a 4797. So there's more to learn than just that basic. But when we're looking at the simple term of capital asset, the reason we care when we're dealing with a capital asset and when we're not is that most of the time when we sell a capital asset, if that asset is held for personal or investment use, then the sale of that asset will get reported on Schedule D. And if the asset is a depreciable asset held for income production, then that sale typically gets reported on 4797 or as an inventory item. So let's look now at how we determine the cost basis of property. Your cost basis in property is usually your purchase price. However, any of the following situations can give you a different cost basis. Firstly, you received the property as a gift. You inherited your property. you received property in exchange for services that you rendered, or you paid transfer tax and insurances or other closing costs upon the acquisition of your property that you could not or chose not to expense. So let's look first at property that you receive as a gift, because gifted property is actually one of the more complicated assets to figure basis in, because there's some special rules that relate to it. And I'm not even going to get into rules that relate to gift tax. That's a more complex area of tax law, and we're not going to get into gift tax as it affects basis today. Rather, we're just going to look at someone gave you a gift, what's your basis in that gift? If you received property as a gift, you must know its adjusted basis to the donor just before it was given to you, its fair market value at the time it was given to you, and any gift tax paid on it. Then apply one of the following two rules to calculate your gain or loss when you sell or dispose of the asset. There are two rules that we look at. The first one is that the fair market value at the time of the gift is less than the donor's adjusted basis. So if I give you a comic book that I paid $500 for, but the value of the comic book has dropped. There's kind of been a slump. The comic book market is soft. So even though I paid $500 for it, the value has dropped to $300. Then I have a situation where the basis to me, the donor, is less than the fair market value at the time that I give it to you. In that type of situation, to figure a gain, your basis is the same as the donor's adjusted basis. And to figure a loss, your basis is the fair market value of the gift when you received it. So let's think about this a little. If I give you a comic book that I paid $500 for, but is only worth $300 at the time I give it to you, and then you go, that's pretty cool, but I'm cash tight. I'm going to sell that comic book and get some money for it. Well, if you sell it for $200, then you've sold it at a loss, and your basis is going to be $300 because it's the lesser of the fair market value or my basis when I gave it to you. But if you sell it for $600 because the value went up, then your basis will be what I paid for it, which is $500. And if you sell it for $400, then you have neither a gain or a loss because it's somewhere in between those two numbers. Now let's look at the rules when the fair market value at the time of the gift is equal to or greater than the donor's adjusted basis. This one's a little bit simpler. To figure gain or loss, then the basis will always be the same as the donor's adjusted basis. So your basis in a gift may increase or decrease because of certain adjustment items which take place after you receive the gift. And these adjustment items can include allowable depreciation, casualty or theft losses, as well as capital improvements that you make to the property after you acquire it. You should note that the bottom line purpose behind these rules is that they are designed to minimize loss and maximize gain for IRS tax purposes. So if you dispose of gifted property for a price that falls between the basis and the fair market value at the time you received the gift, then there is no profit or loss on the disposition. So I've got some class exercises here. I'm going to ask you to exercise your brains pretty early in the day before I've put you to sleep with monotonous talk. And so I've got some series of 5 exercises up on the screen in front of you, and I'm going to open up some poll pods. And what you can do is go through these questions in turn and give me your best shot at an answer. So question number 1, for example, says, Jackie received a gift with a fair market value of $100 and a basis to the donor of $150. Jackie sells the gift for $180. What is Jackie's profit from the sale? And your job is to just take a minute to think through this problem and tell me what you think the correct answer is. Okay, it looks like everybody who's going to answer has answered. And the majority of you have picked the correct answer, which is A, $30. So let's think through this a little. Jackie received a gift with a fair market value of $100 and a basis to the donor of $150. If she sells the gift for $180, what is her profit? Well, the basis to the donor is $150, and she sells it for a profit. So the profit is going to be the difference between the donor's basis and what she sells it for. $150 from $180 is $30, which is why A is the correct answer. All right, so let's move on to the next question in this series. Question number 2 So Henry received a gift with a fair market value of $150 and a basis to the donor of $100. He sells the gift for $80. What is his loss from the sale? Okay, no slouches in the room today. You've all got the correct answer, which is A, $20. And this time, because the gift is sold at a loss, he's going to go to the basis to the donor because it is less than the fair market value on the date of the gift. And of course, the basis to the donor is $100. He sells the gift for $80, and that means that there's a $20 loss. Moving up to question number 3. In question number 3, Sally received a gift with a fair market value of $120 and a basis to the donor of $80. She sells the gift for $100. What is her profit or loss from the sale? So this one had you guys working a little bit harder up here. There's disagreement in the room. And actually, the correct answer is C. Let's see why. We have a gift with a fair market value of $120 and a basis to the donor of $80. Well, when we're selling the gift at more than the basis, we're always going to have to report the gain. And in this case, the difference between the basis of the donor and the amount that the gift is sold for at $100 is $20, and that's why C is the correct answer. Question number 4. In question number 4, George sells a gift with a fair market value of $120 and a basis to the donor of $100. He sells the gift for $150. What is his gain from the sale? All right, I can see that 2 of you are standing by and not answering, but the 3 of you who did answer do have the correct answer. Number 4 and number 3 are essentially the same question, just with different numbers. In both cases, 3 and 4, we're looking at what is the basis to the donor. In this case, it's $100. And what is the sales price? $150. Since the basis is less than the fair market value, we use the basis, and 100 from 150 is $50, which is why B is the correct answer. And the final question in this series of exercises is question number 5. Jack received a gift with a fair market value of $100 and a basis to the donor of $150. He sells the gift for $50. What is his loss from the sale? All right, and all of you got this one correct as well. Let's look at what we're dealing with. We have a fair market value of $100 and a basis to the donor of $150. Because we're selling the asset at a loss, we're going to use the lesser of the fair market value or the basis of the donor. In this case, we start with the fair market value because it is the lower number, and it's going to minimize the loss. Instead of being allowed a loss of $100, which you would get if you took the donor's basis and subtracted the selling price, you're going to have to go with the fair market value and subtract the selling price. And, of course, that means 100 minus 50 is 50, and B is therefore the correct answer. So that's it for talking about gifts. And now we're going to move on to inheritances. I like inheritances. They're just simple as far as I'm concerned. Oh, you inherited the property? Now I know your basis. It's that simple. Because you just have to understand some basic rules about figuring the basis for inherited property, and you're fairly much done. Now, there can be some complexities if the inherited property has been held long term, but very often inherited property is sold soon after acquisition, and you're just dealing with the sale of inherited property early on. But if inherited property has been held long term, then you are going to have to do some more complex calculations, but those would be no different than if you had actually purchased the property. So let's talk about inherited property now. Basis calculations for inherited property are usually simple to calculate, and this is because the basis in most inherited property is the fair market value of the property on the date of death of the decedent. However, the following information should be observed when determining the basis of inherited property. Firstly, we have to look at when the person died. And there is a special rule in play for 2010 only. If the decedent died in 2010, then the rules that I'm talking about may not apply. But if the person died before 2010 or after 2010, in other words, not in 2010, then these are the rules that apply. If you acquired property through inheritance from a decedent who died before 2010, or after 2010, then your cost basis is the fair market value of the property either on the date of death of the decedent or 6 months after the date of death of the decedent. Now, the decedent's estate decides or establishes which valuation date shall be used. And once the estate establishes a valuation date or chooses either the date of death or 6 months later, then that same date shall be used for all assets of the estate. The date property is distributed to the beneficiaries ultimately has no bearing on the issue of basis. So if Mr. Jones died on June 30th of, let's say, 2013, but the decedents don't receive property distributions from that estate until 2015, you're going to be going to the June 30, 2013 date of death for valuation purposes. And what date those decedents finally get their property distributed to them in 2015 is not relevant for a basis determination. Now, what happens if the decedent died in 2010, in other words, died after 2009 and before 2011? Isn't that IRS speak to make something as simple as that so complicated? Well, if you inherited property from a decedent who died in 2010, special rules may apply for calculating your cost basis, and there are two options for how executors could treat assets in estates of decedents who died in 2010. The estate executors in that 1 year only could choose to apply the same estate tax rules for property acquired from a decedent who died before or after 2010, which I just described, or they could elect out of the estate tax rules for 2010 and use a modified carryover of basis rules under Section 1022. Well, ultimately, of course, when George Bush II came into office in 2001, one of his big platform issues with him and the Republican Party in general was to eliminate this odorous death tax that was crippling our nation's economy, or how they made it out. At any rate, so they actually did get a law passed that would repeal the death tax. But because of the impact it was going to have on the economy, they were only able to get it repealed for a single year, 2010. And so it just sat there in limbo year after year after year while there was feuding going on in the government about whether or not it would be extended. Lots of people were opposed to it, and ultimately the repeal was not extended. And so only for 2010 do we have the special rules in play. And ultimately what they meant was that if a person died in 2010 and they were worth a lot of money, more than $5 million, then the estate would not have to pay estate tax, but the estate was going to have to figure the basis of assets held by the estate based on what the basis was to the decedent. And you can just imagine what it might be like trying to figure out what a decedent's basis is if they're dead and they can't tell you where the records are, or how to interpret them, or work off their memory. Very complicated. And the fact that we do work, in most cases, from the date of death or 6 months later really simplifies things. We don't have to worry about what a decedent paid for something and what depreciation deductions they may or may not have taken. It doesn't matter. All that matters is what the asset was worth on the date that they died, and that's why I think figuring the basis in inherited property is so easy. Now let's move on to the next topic, which is property received in exchange for services rendered or barter. Generally, you must include the fair market value of property you received in exchange for services in your income, and your cost basis will then be the fair market value that you included in your income in the year that you acquired the property, plus or minus any adjustments. So let's talk about what is meant in this situation. Barter is a pretty common thing. You've probably encountered it as a tax preparer. I mean, I wasn't in this business very long before I had clients wanting to barter with me. The first client who wanted to barter with me was a roofer, and he wanted to trade his skills as a roofer for my skills as a tax preparer. And ultimately, he also put in skylights, and so I did have a need for skylights. And so we had an exchange where I prepared his tax return at no charge, and he installed 2 skylights on my roof. Now, I thought that was a fantastic deal. It was a steep-pitched roof, and they were heavy, and I had no clue what to do. It just wasn't going to happen, and even if I did attempt it myself, it was going to be a mess. So I was only too happy to prepare this man's tax return in exchange for free skylights. Not free skylights, but free installation of skylights. So this was definitely a barter situation. So what is or was my basis in those skylights with that house that I sold a number of years back? Well, the answer is that my basis in those skylights would be the fair market value of the services he performed in installing them, which I then included in my income for that year. All right, let's look at closing costs and other acquisition costs. If you purchased a home or other real estate, you will nearly always pay closing costs. And closing costs can include escrow, title, and recording fees, taxes charged on purchase, loan assumption fees, points, discount points or loan origination fees, and points are generally a percentage of the mortgage amount and are considered to be a form of prepaid interest. So although they are closing costs, they don't necessarily add to your basis. And then finally, other settlement charges that you've paid to acquire the property. Now, an illustration of how closing costs are added to the basis of property is shown on page 7, so I'm going to get that to that in a minute. You should also note that the rules regarding the treatment of closing costs vary depending on whether the loan is for personal use property or business use property. And costs that you might incur upon the purchase of property other than real property can include sales taxes, loan fees, title fees, and registration fees. And these are common with cars, but can be paid on other assets too. And finally, delivery and installation charges. So let's just think for a moment. Perhaps I own a restaurant and I need to purchase a pretty expensive, high-range cooking appliance into my restaurant, and that cooking appliance is going to cost over $20,000. So I order that cooking appliance, and I pay $20,000 for it. Well, if I'm in a state that imposes sales tax, and nearly all of them do, then there is going to be sales tax that I have to pay on that cooking appliance. And then on top of that, there is going to be delivery and installation of that cooking appliance. And let's just suppose that's another $1,500. So if I pay $1,000 of sales tax and $1,500 for delivery installation, and I pay $20,000 for the appliance itself, I'm going to add those numbers together. And when I do, I get $22,500, and that becomes my basis in that asset. Whether I hold it for business use or personal use, that is my basis in the asset. But if I hold it for business use, I could begin to depreciate it once it's placed in service for business. All right, adjusted basis of property. Adjusted basis is the cost basis of your property plus or minus any of the following: amounts you invested into your property to improve its value, add to, or extend its useful life, and amounts that you claim as a tax credit or just tax deduction upon the acquisition of property. These obviously can reduce your basis. Postponed gains from the sale of your home, and those go back in time quite a bit, but if you have a home that you sold and then you purchased another home before May 7, 1997, then you may have a postponed gain from the sale of your old home. Also postponed gains from a like-kind exchange, an amount you claimed or are presumed to have claimed for depreciation on property that you use for business, or any other amounts you receive in relation to the property that have not previously been reported in your income. So let's look at some examples of adjustments to basis. And in the first column, we're going to look at things that increase your basis, and in the second column, we're going to look at things that reduce or decrease your basis. So increases to basis can include capital improvements, and these are things like putting an addition on your home, replacing an entire roof, repaving your driveway, installing central air conditioning, and rewiring your house. Those are all capital investments into the home. They improve the value. They extend its life. They're definitely expensive, and they do add to basis. Other items include assessments for local improvements such as water connections, sewer hookups, sidewalks, and roads. If you have a home that is currently on septic and the city comes along and says we're going to give you sewer, they're going to probably do an assessment against your home to pay for the cost of connecting that sewer. Whether you want the sewer or not, there's going to be a decision made that you're going to get sewer, and they're going to come along and slap an assessment on your property that you're going to need to pay off over time, or at least when you sell the property. And whatever the amount of that assessment is, that's going to add to your basis. Casualty losses, that is restoring damaged property back to its original condition. Legal fees, the cost of defending and perfecting a title, and fees for getting a reduction of an assessment. So let's look at where you might have a legal fee associated with property that you own in terms of defending or perfecting title. Let's just suppose you are owner of a piece of land and you've got just a nasty neighbor who comes along and claims that there's some kind of dispute over the property line, and they're suing you for whatever it is they think they're losing because of this property dispute. You go to court and you pay an attorney to defend your right to your own property. At the end of that term, you win. And so you've paid all of these legal expenses, and you probably feel like I should be able to deduct these somewhere. And the answer is, sorry, you can't. But what you can do is take those legal fees and add them to the basis of your property. Another place where I see legal fees coming into play, some states actually go, when you purchase a home and go to close on that home, you employ an attorney to do all the legal documentation that goes along with that. And so the very act of buying a house will involve an attorney, and that's where you're going to have those legal fees. Now, in other states, Oregon being one where I'm located, attorneys are not typically involved in the closing process on a house at all. Instead, we use companies called title companies to perfect those sales. But I know that in some states, lawyers are involved. And whether it's a title fee or an attorney fee for purchasing a home or purchasing property, either way, it will add to your basis, whatever that cost is. The next one we have is zoning costs. You might pay money to have your property zoned for business purposes or zoned for farming purposes. Whatever those fees are that you pay to get your property zoned, those are going to add to your basis. Taxes and interest paid on unimproved real property if the election to capitalize these costs is made. So this is taxes and interest paid on unimproved real property. And what is the definition of unimproved real property? Well, that's land, vacant land. Unimproved means there's nothing built on it. So a land improvement would be a structure in most cases. So if you build a structure on the property, now you have something that you can depreciate. But when you just purchase vacant land, you've just got the land, and land is non-depreciable. So one of the things that can happen when people purchase vacant land is it could be the case that they've borrowed money to purchase it, and obviously it's often the case that they're also paying real estate taxes on it. Well, real estate taxes can be deducted on Schedule A, but the interest that you pay on a loan for vacant land is not going to be deductible on Schedule A as residential interest. So when you go to Schedule A and you claim a deduction for mortgage interest, because that's what Schedule A says is mortgage interest, what it's really referring to is mortgage interest paid on your primary or your second home. Well, since you don't live on vacant land, because there's no structure on it, you can never make the argument that the vacant land is my home. And therefore, the only way you can claim a deduction for interest paid on vacant land is as investment interest expense. That, too, is claimed on Schedule A, but it is subject to a limit. And the limit is that your investment interest expense cannot exceed your investment income. Well, if your investment income is limited, and by investment income we typically refer to interest and dividend income, but in certain cases, if elections are made, also capital gain income. If you don't have enough investment income, then what you're going to be dealing with is investment interest that just can't be deducted. So it can make sense to capitalize the interest that you're paying on that land instead. And you can do so. You can capitalize the interest and property tax that you paid on the vacant property that you own, as long as you make an election to do so according to the rules. And then finally, real estate tax is mortgage interest paid on behalf of the seller. If you purchase property and then in the purchasing process you see that the seller owes certain amounts for real estate taxes and mortgage interest and you agree to pay those amounts are not deductible to you, but they do add to the basis or your cost in the property that you've bought. So now let's look at decreases to basis, things that will cause your cost in the property to decline. Firstly, we have the Section 179 deduction. We also have the deduction for clean fuel vehicles and refueling property, non-taxable corporate distributions, deductions for previously allowed or allowable for amortization, depreciation, and depletion. And I just want to point out how important this or allowable phrase is. Deductions previously allowed or allowable. What that means is if you could have taken the deduction, even if you didn't take it, you are treated as if you had, and it's going to reduce your basis. Also, exclusion for subsidies for energy conservation measures, the credit for qualified electric vehicles, postponed gain from the sale of a home, investment credit, part or all that was taken, casualty and theft losses and insurance reimbursements, certain canceled debt excluded from income, rebates from a manufacturer or seller, easements, and tax credit or refund for buying a diesel-powered highway vehicle. So let's look now at amount spent to improve or extend the useful life of property. An amount a person or business spends to improve or extend the useful life of property is one of the more confusing concepts for taxpayers. Many people expect that they should be able to claim an instant deduction when they spend money on their property. So for example, I'll give you a typical situation that I run into regularly every tax season. I have a client, we'll name her Jan. And Jan is quite excited because she's purchased a new house. And it's her house. She's going to be moving into it. She has another house that she's living in now, but she's going to be putting all of this money into this new house that she wants to live in. And so she buys it for $300,000, and then she spends tons of money fixing it up, repairing problems, putting on a new roof, remodeling rooms, doing wiring, spends all this money. And she comes in to see me, and she's really excited. She's got all of these receipts that she pulls out proving all of her expenses. And the sadness, the despair that I see in her eyes as I tell her, you know, there's not much we can do with those. They add to your basis, though, so don't lose them. I'm glad you saved those because those are important documents. But they're not going to help you with your tax situation today. They're going to help you with your tax situation at some time down the road. That sometime down the road is either when you decide to convert that property to business use, perhaps as a rental, or maybe you sell it and for whatever reason you're not able to exclude all of your gain, then those amounts are going to come into play for purposes of showing increased basis or cost in the property. So again, many people expect that they should be able to claim an instant deduction when they spend money on their property. And while the law does allow for certain instances when a current year deduction can be taken, such as a residential energy credit, it is more often the case that a deduction will not be allowed. If you use property for personal purposes, your home or your car, for instance, you generally cannot claim a deduction for the acquisition cost of the asset or for the costs that you incur to improve or maintain that asset. So let's look here at some expenses that you would pay on the purchase of a house. Some of them ultimately are deductible, and others are non-deductible but would add to your basis. And in this example, you purchased a home for $200,000. The closing costs you paid when you acquired the home included the following. Firstly, there's the purchase price. You had to come to the table with enough money for that or enough financing for that. And then on top of that, you also had to bring money to pay title and recording fees, title insurance, and other costs. So when you add all of these amounts up, you get $203,100. Now, in addition to those amounts, you also had to bring more money to the table to pay a loan origination fee of $1,500 and property taxes that were prorated for the year of $1,500. Now, the loan origination fee does not add to your basis in the property, but it is deductible as long as its points are figured as a form of prepaid interest. And these points would ultimately be deductible on Schedule A. And the property taxes are going to be deductible as well. But typically when you go to close on a property, the property taxes that you bring to the table on the property are actually going to go into an escrow account. So you're being told at the time you close that you need to bring enough money to the table so that they can funnel at least 3 months into escrow for property taxes. And then each month after that, you're going to need to be contributing additional amounts so that the escrow has enough in it to pay property taxes when they become due. But it isn't until those property taxes are actually distributed from escrow and used to pay the tax that you ultimately have a deduction. But we're going to assume in this situation that you brought money to the table to pay the property taxes and that those property taxes ultimately were properly distributed. And if they were, assuming they were, you're going to be able to deduct the property taxes as well as the loan origination fee points on your Schedule A. And the amounts that you do not get to deduct are the costs of purchasing the house, which is $200,000 purchase price plus the title and recording fees. Now, the total cost of acquiring the home is $206,100, but the cost basis, if you ever sell it or decide to turn it to business use for depreciation, will be $203,100. Now, to calculate your basis in the home, typically what I look at when I'm examining closing papers for a client, and I ask to see these regularly, whether they've purchased a home that they are then just going to live in, or whether they've purchased a home that they plan to rent. Either way, I ask to see the settlement statement, that HUD settlement statement. It's usually 2 to 3 pages long, and it lists who the buyer is, who the seller is, and all of the fees that have to be paid, line after line after line. In many respects, it looks like a tax form because the lines are numbered. And the reason I want to look at those forms is I'm looking for the items that are deductible. I'm looking for the points, and I'm also looking for tax prorations that occur on those statements, and how to read those statements and how to look for those items. That we actually covered that in an earlier course in our series on Schedule A, itemizing taxes, interest, and charity. So that's the course you'll find that topic in. But again, it's important to look at those closing papers because there are numbers on there that will add to basis. And if you are taking that HUD statement and looking at the numbers on it because you are figuring basis for a person who is converting the property to a rental, then you really need to be scouring that and determining what amounts on those closing papers are going to be capitalized and become depreciable, what amounts are going to be amortizable as loan fees, and what amounts are going to be deductible as business expenses of the rental property or whatever their business purpose it had. Now, any future amounts after you acquire the property that you spend to improve or extend its life add to its adjusted basis and are generally referred to as improvements. And if the improvements are made to your home, then we call them home improvements. Now, home improvements can include amounts you spend on room additions, adding a second story, installing a new roof, fence, deck, or patio, remodeling one room or the entire house, rewiring, replumbing, residing, or other similar improvements, adding to or replacing fixtures such as appliances, lighting, doors, etc. Also, city or county assessments for roads, sidewalks, and sewers. And these home improvements add to your cost in the home and increase your adjusted basis in it. So what expenses do not add to basis? Well, expenses that don't add to basis include repairs, such as fixing a broken lock or a hole in a leaky roof. So how do you draw the line? Sometimes it's not real obvious what's an expense and what's an improvement. Quite frankly, I don't necessarily always agree with the IRS on what is an expense and what is an improvement. For example, it's actually written in the IRS instructions, when we get over to rental property, you'll see it there, that if you repaint a home, that's a repair, and you would write it off as a maintenance cost of maintaining a rental property. But I look at painting a home as definitely improvement. Obviously, it's worth more after you've painted it. It's a substantial investment, and it extends the useful life of the property. So it seems to me that repainting a home would be an improvement. But IRS says, no, it's a repair. So some things are not so obvious, but other things are pretty obvious. Obviously, if you have a hole in a leaky roof and you fix it, that's going to be a repair. But if you tear off an entire roof and then do repairs underneath that and put on a whole new roof, that would clearly be an improvement. So sometimes it's harder to see and sometimes it's blatantly obvious. Now, maintenance costs such as mowing or maintaining your garden, cleaning your carpets, spraying for carpenter ants, cleaning your chimney, etc., also do not increase basis, nor do costs of refinancing your mortgage or insurance premiums. Tax deductions and credits that are claimed upon the acquisition of property. Well, if you claimed a deduction or a credit because you acquired the property that was given special treatment under the law, you must subtract the amount that you deducted from your income or was credited against your tax from your cost basis. Now, examples of the types of deductions you might have been able to claim include points on a loan to purchase or improve your main home, the Section 179 deduction for property that you placed in service for your business, or depreciation or amortization deductions on property that you used for your business. And examples of credits that you might be able to claim include credit for qualified electric vehicles, business credits allowed for the purchase or development of property, including purchases or installation of certain energy efficiency devices, advanced energy projects, rehabilitation projects, and disabled access expenses paid by a small business to comply with the Americans with Disabilities Act. Depreciation and amortization. If you previously claimed or should have claimed depreciation on your business asset, you must subtract any depreciation allowed or allowable from your basis in your property. So I mentioned this a few minutes ago, and this is something that often causes trouble. So I have a client coming to me for the first time, and what I automatically want to do is see their tax return for at least last year and preferably for a year or two before that as well. And if they've got any assets that they're using in their business, I'm going to be looking for depreciation calculations that were done on that. And depreciation is just something that I see so much of a mess being made out of. Whether the client is doing their own tax return or whether they have been using a paid professional, I often see depreciation done badly. In other words, the rules have not been followed, things have been deducted in ways that are not allowed, or they haven't been deducted at all as they should be. It's not at all uncommon. And what IRS says is that when you sell an asset for which depreciation or amortization could have been claimed, your basis in that asset is going to be reduced by the amount of depreciation you could have claimed even if you never claimed it. In addition, IRS says if you claimed too much depreciation on an asset, you're going to be treated as reducing your basis by whatever depreciation you actually allowed yourself. So we're going to talk a little bit about these rules right here. Firstly, on this header right here, allowable depreciation. Allowable depreciation reduces your basis in property that you own even if you did not claim a deduction for it. And here is an example of what I mean. Rhonda converted her home to rental use in an earlier year, and her basis in the rental house is $200,000. When Rhonda properly reported income and expenses from the rental property on Schedule E, she did not claim any deductions for depreciation. Had she claimed depreciation deductions, her accumulated depreciation would be $20,000, and that would make her adjusted basis in the property $180,000. Now, why wouldn't a person take depreciation? Well, there's two reasons why I see people not take depreciation. The first reason is they know that depreciation is possible, but it's too complicated for them to figure out, and so they just can't be bothered. Another reason is, kind of along the same lines, they're afraid that this rule for depreciation just doesn't make sense to them and that they're going to get in trouble if they claim depreciation, and they don't want to cause any troubles with the IRS, so they just don't claim it. The other reason I see that depreciation is not claimed is when tax preparers just flat out don't put it on there. The client has come in and used a tax preparer, paid a professional preparer to do their tax return, and the tax preparer either does not know how to do depreciation or has just been too lazy to notice that it's required and just hasn't done it. I mean, it's a pretty obvious thing that there's a line on Schedule E and on Schedule C to claim depreciation deductions. And if those lines are blank and there are assets being used for business purposes, then that's something that's quite troubling. So I always examine depreciation, and I also examine the types of assets that are being depreciated and the useful lives being claimed on them. Because just as often as I see no depreciation being claimed when it should have been claimed, I also see assets being depreciated with the wrong life. The wrong useful life has been selected for those assets, for example. So in this situation, her basis in her property should be $180,000, and it is $180,000, even though she didn't take the depreciation deductions. You should note that although Rhonda must reduce the basis of the property by the amount of allowable depreciation she could have claimed but didn't, there are some IRS procedures that allow her to apply to the IRS for a change in accounting method by filing Form 3115, Change in Accounting Method, and then completing Section E. In the year Rhonda applies for the change in accounting method, she will be able to claim on her Form 1040, Schedule E, a deduction for all the prior year's depreciation. And for more information on this topic, read the instructions for Form 3115. I can't say that we do 3115 adjustments for depreciation terribly often, but we do them most tax seasons. So, for example, this tax season, I had two clients that we did a change in accounting method for on their depreciation. One client came in and too much depreciation had been claimed. I don't know where her tax preparer got the numbers for depreciation. When I asked her for the closing papers from the purchase of this rental property and then saw the amount of depreciation the old preparer was claiming, there was just no way on earth that it was possible to get the large number that that preparer had calculated. So ultimately I sat down and we figured out what her actual cost basis in the property was, what the allowed depreciation should have been, and she actually wanted to pay back tax that she took a deduction for in the earlier year, and our earlier years plural. And so we did that and filed 3115, and she has included that money in or income. And when you file 3115, you can actually spread that increase in income out over time, whereas if IRS comes along and figures it out on their own, they can do it to you all at once and slap penalties on it. So it does go two ways. You can use 3115 to make an accommodation for depreciation that was not claimed when it should have been, and you can also use it to make an accommodation for too much depreciation that was claimed. All right. I see a question up on the board here from Richard. He says, if I inherit a rental house, I receive a stepped-up basis. Is this the fair market value at the date of death then need to be adjusted for prior depreciation taken? The answer is no. The prior depreciation on inherited property doesn't exist. You start with a clean slate. That's why inherited property is so easy to deal with. There's the date of death. You get the property appraised. Whatever it appraises for, that's your basis. And then if you start putting money in to fix it up, you might have some adjustments to basis. And clearly once it's placed in service, if you decide to keep it as a rental property, then depreciation would begin on that date. And interestingly, when you place property in service that you acquired through inheritance, the date you place it in service is called inherit. And you literally write the word inherit as the date acquired on this Form 8949. All right, so let's talk about postponed gains from the sale of your home. Now, if you filed Form 2119 upon the sale of your personal home prior to May 7, 1997, you must reduce your basis in your current home by the gain you postponed on the sale of your former home. Now, if you haven't been around long enough doing taxes, you may not even remember that this rule existed. But I remember it really well because I was preparing tax returns professionally beginning in really 1994. And I was working in the tax industry a full year before that. I was involved in the industry for an extended period of time where everybody knew about the rules relating to postponed gain. It was common knowledge. Well, it was common knowledge, but not everyone knew, let's put it that way. That what would happen is if you purchased a home and then lived in it as your main home and then you wanted to sell it and move into a new home, the IRS had this rule that you could sell the home and you had 2 years to replace it with a new home. And as long as the new home cost as much or more than the old home, you could postpone your gain. And you did that by filing Form 2119. So most people sell their homes about every 7 years and move on. And so for most people, this rule just doesn't apply. They haven't got a home that they purchased with a postponement of gain prior to this May 7, 1997 date. But there still are going to be people out there. There are people out there that purchase a home and live in it for many, many years, often up until the date that they die. And so it is perfectly possible to have someone come into your office who is now selling a home that they purchased prior to May 7, 1997, and that prior to the purchase of that home, they actually sold another home and postponed gain on the sale of that other home as they purchased the new home. And that's information that you have to factor in. Now, of course, what happened on May 7, 1997 is that was when a new law was introduced, the one that we know well, and that new law says that you can exclude from income up to $250,000 of gain on the sale of your main home, or $500,000 if you are married filing a joint return. And that's been a pretty good deal. People have been happy with that deal, and so the old deal of postponing gain because you purchased within 2 years is kind of lost in history. But anything more to cover about sale of home is in a separate course, and we cover that in our 1040 CPE series course called Sale of Home. Next topic is postponed gains from like-kind exchanges of business or investment property. And postponed gains on like-kind exchanges work very similarly to what I just described on postponed gain on the sale of a home. But the difference here with like-kind exchanges is that there has to be a trade of one piece of business property for another piece of business property, and they must be like-kind. But you do not have a like-kind exchange when you sell property, use the money from that sale to then buy other property. That does not create a like-kind exchange. But if you have a car that you've been driving for business use and you go to the dealership and you trade it in on another car, that is a like-kind exchange. And people also maneuver ways to do that with real estate. The way it works when you trade in a car, let's just suppose you've got a car with a cost to you of $8,000 and a fair market value of $5,000. And you trade it in for a new car costing $10,000. Well, your basis in the new car is going to be your basis in the old car plus whatever boot you bring to the new car. But if you've claimed depreciation, that has reduced your basis. So if you paid $8 for a car that's now worth $5, but over time that you've been using that car, you've reduced the basis to $2,000. Then you've got a situation where the fair market trade-in value of that car is going to be $5, and the purchase price of the new car is going to be $10, and you're going to have to bridge that gap with something we call boot or cash. So you're going to come to the table with a $5,000 fair market value car and trade it for a $10,000 car. So you're going to bring your old car plus $5,000. But because of depreciation deductions you previously took, that car you paid $8,000 for now has adjusted basis to you of $2,000. So what's your basis in the new car? It's going to be the $2,000 adjusted basis in the old car plus the $5,000 of cash you bring to the table for the new car, and that makes your adjusted basis in this $10,000 car $7,000. There are similar rules you have to account for when you trade one piece of property for another piece of property, and the property that you are trading in is worth more than the property you're receiving, so that you receive cash. The rules work a little bit differently there. In any event, we cover all of that in a course that I'll be covering later in the year called Like-Kind Exchanges. So important rules relating to the basis of real estate. There are a number of common events that can affect the basis of real estate, and IRS rules for these events are described here. Firstly, we have real estate taxes that were paid for the seller by the buyer. If you paid real estate taxes owed by the seller of property as part of your purchase cost of the property, then you will add the taxes that you paid for the seller to your basis in the property. You cannot deduct them as taxes paid on Schedule A, C, or E because those are expenses that were assessed against property that you didn't own. You may have paid them, but you didn't own them, and they're only deductible if you owned them. So what that means is they are a cost of acquiring the property, but they're not deductible to you. They just add to your basis. Now let's look at the other side, real estate taxes that are paid by the seller for the buyer. If you are the seller and you paid taxes for the buyer, then you will add the amount paid to your basis, and the buyer will then deduct as appropriate on Schedule A, C, or E. You do not deduct on Schedule A, C, or E yourself. Only the buyer deducts. Settlement costs which add to the basis of property include settlement fees and closing costs in the basis of property that you buy. A fee to buy property is a cost that must be paid even if you bought the property for cash. The following items are some of the settlement fees or closing costs that you can include in the basis of your property. Charges for installing utility services, legal fees including title, search, and preparation of sales contract and deed, recording fees, surveys, transfer taxes, owner's title insurance, and any amounts that the seller owes that you agree to pay, such as back taxes, interest, recording, or mortgage fees, or charges for improvements or repairs, and sales commissions. But don't get into that number, or don't lump into these settlement costs any additional amounts that you pay because you borrowed money. Loan and other costs are not added to the basis of property, so do not add any of the following amounts to the basis of your property. Costs and fees paid for getting a loan on the property, or amounts placed in escrow for future payment of items such as taxes and insurance. Now, when you borrow money, you typically have to pay loan fees, and examples of loan fees include points, mortgage insurance premiums, loan assumption fees, the cost of a credit report, fees for an appraisal required by a lender, and fees for refinancing a mortgage. And these items do not add to your basis in your home, but they could be lumped together as a separate cost and amortized if they're incurred for business purposes. Escrow items, the following items are examples of settlement fees and costs that you cannot include in the basis of your property: fire insurance premiums, rent paid to occupy a property before closing, and charges for utilities or other services related to occupying a property before closing. So let's think a little bit about how you would have rent paid prior to occupying a property before it closes. Let's just suppose you found the perfect house, and you've put the offer in on it, and everything's going through the process for you to close. But meanwhile, your own house has been sold, the one that you're living in, and it's going to close, and you're going to have nowhere to live. So you know where you're going, it's just that it hasn't closed, and you know where you are, but you're going to get kicked out, and so you've got this limbo period. What are you going to do? So you approach the sellers of the property you're buying, and you say, we'd like to move in 2 weeks before close. This happens quite frequently. And so the sellers say, yes, we're going to agree to do that, and you will need to pay us $500 or $1,000 a week until we close. And any of that rent that you pay prior to closing does not add to your basis in the property. It would be income to the sellers, however, and they would need to report that as rental income received. I actually see that we are at an excellent point to take a break, and so I'm going to do that. This break will last 10 minutes, and I'm also going to give you a password. I am going to give you 2 passwords today. Password number 1 is SWORD, S-W-O-R-D, SWORD. And while we're on break, I'm going to put a couple of questions up on the board from the C exam, which is the special enrollment exam on basis of assets, and let's see how you do on those while we're on break. All right, everyone, welcome back from break. I left you with a couple of problems from the C exam, which is the examination IRS gives to people who want to become enrolled agents. And I'm going to take each of these tests in turn. Firstly, let's look at C question number 1, and I'm going to let you see now how people answered. This question made people think a little, and it is supposed to. And one of the reasons the C exam is a tough test is because a lot of people can't pass it, even if they've been doing taxes for a very long time. And in this case, 50% of you selected the correct answer, and that is B. So let's see where we get the correct answer from. Bill, a tax preparer, agreed to prepare the corporate tax return for the EZ Interior Decorating Company. It was agreed that Bill's fee would be $4,500. EZ was experiencing cash flow problems and offered Bill a computer with a fair market value of $3,500, a printer valued at $4,000, and a monitor worth $250 instead of the agreed upon $4,500. EZ had paid $6,000 for these items, and Bill accepted the equipment in lieu of cash. What is Bill's basis in the property he received? Well, his basis is going to be the fair market value of these assets. For example, if he was to turn around and sell them so he could get the cash out of them, that's what he could reasonably expect to get for them. And so that is why $4,150 is the correct answer. That's $35 plus $400 plus $250. That gives you $4,150. The next question is actually a more straightforward question. And most of you did get this answer correct. The correct answer is C, $24,000. Let's see why. Tony purchased a truck to be used in his excavation business. The truck's cost was $22,000, and in addition, Tony paid sales tax of $1,100 and $900 in freight to have the truck delivered immediately from another dealer. What is the depreciable basis of the truck? Well, the depreciable basis of the truck is going to be what he paid for it, plus the delivery charge, plus the sales tax that he paid on it. All of that is lumped together and becomes his basis in that asset. And, of course, those expenses, 22 plus 11 plus 9, equal $24,000, which is why C is the correct answer. All right, so picking up with where we left off, we're going to be moving on now with loan and escrow costs paid to acquire business use property. If you paid loan or escrow costs relating to business property that you own, you should capitalize or deduct these costs as follows. Firstly, loan fees. Loan fees are capitalized and are amortized separately from the property that you purchase. So if you're preparing a depreciation schedule for your client, you would have one line on the depreciation schedule where you would enter the cost of the structure, let's say. You've purchased a commercial building. And on that commercial building, you have a line for the cost of the building, and you should subtract out the land value, by the way. We'll cover that when we get to my class next week called Depreciation Made Easy. But just for today, I'll tell you land is never depreciable, and if a building that you purchase is on land, then you always have to figure out what that land is and subtract it out. So you subtract out the land, you depreciate the building. And that's a separate line on the depreciation schedule from the loan fees that you paid. Those are going to be taken as a separate number, and they're going to be amortized separately over the life of the loan. So if you have a commercial building that's being depreciated over 39 and a half years, that would be one line on the depreciation schedule. And then if you have a 30-year loan, that would be a separate line on the depreciation schedule, and it would actually be amortized rather than depreciated. So here is another example. The purchase price and closing costs of a residential rental property are depreciated over 27 and a half years. The loan fees paid to purchase the rental property are amortized separately over the life of the loan. And here's an illustration. A rental house is purchased at a cost of $120,000. $100,000 is allocated to building and $20,000 to the land. Loan fees paid on acquisition of the property totaled $3,000. The cost of the rental property and the loan fees should be entered on separate lines of the depreciation schedule as shown next. And it's exactly as I described. We take the asset, which is being depreciated, which is the building, and we enter the cost of the building. We then enter what the depreciable basis of that building is, which is the acquisition cost minus the land value. And then the life of the building, 27 and a half years. The method under which we're depreciating it is MAKERS, and the depreciation deduction allowed in this particular year is 3636, assuming it's a full 12 months of depreciation. Loan fees. The cost of those is $3,000, the depreciable basis. And really, truth be told, the word would be amortizable basis is going to be $3,000. The life will be 3 years, and that would allow for an amortization deduction each year of $100. So escrow items, these are items that are deducted as operating expenses at the time payment is made from escrow. For example, Tammy's monthly mortgage payment is $2,000, and every month $200 of the total payment is deposited into an escrow account, which is used to pay her annual property tax bill. And then another $50 from each payment is deposited for use in paying insurance premiums for the house. The amounts deposited into her escrow account are not deductible to her until the money is distributed from escrow and used for these purposes. In addition, the amounts in her escrow account do not add to her cost basis. Insurance premiums and property taxes that are paid from escrow are costs of keeping up the home and are allocable as rental expenses to her. These are deducted on Schedule E, but they don't add to basis at all. Now, I can tell you that in the past few years, on a couple of occasions, I have seen instances where the 1098 mortgage statement issued by the lender has not shown real estate taxes were paid out during the year, even though my client is telling me that they should have been. And in both those cases, I determined that, yes, the mortgage company had received the money into escrow, and yes, the mortgage company had failed to distribute it as it was supposed to. So that was a problem, obviously, for the client because they put money away. That money should have been used to pay the property taxes. The taxes were now delinquent, and on top of that, there was no deduction available to the taxpayer because the money was still sitting in escrow and hadn't been spent. So that is something that clients should stay on top of. If the 1098 is not showing the disbursement of property taxes, which often it doesn't, you can look to the year-end statements from the mortgage company because they usually will show you the date disbursements were made for real estate taxes, mortgage insurance, hazard insurance, and so forth. Treatment of loan and escrow costs on personal use property. Loan fees and escrow costs relating to the purchase of your home do not add to your basis in the home. If you paid taxes on the purchase of your home or made escrow deposits to pay property taxes, then these amounts are deductible on Schedule A in the year they are paid. If you paid points on a refinance of your home, you must amortize the points over the life of the loan. And if you pay your loan off early, you deduct any remaining balance of points as a deduction in the year of sale. So let's take a look at an example of how that would work, where points on a refinance of a home are claimed in the year that that home is sold. This is not at all uncommon for a person to purchase a home and pay points when they buy it, and then at some point during the period of ownership do a refi. And at the time you do a refi and pay points a second time, those points are not deductible in full in the year paid like they are when you purchase. IRS says that when you pay points on a refinance, that they have to be amortized out over the life of the loan. And then what happens if you sell off the house before those points are paid off? Well, that's what this illustration is about. Joanne paid $3,000 in points when she refinanced her home in an earlier year, and she has been amortizing the points on Schedule A and claiming a $100 deduction each year. She has recovered $1,200 of her cost in the points paid as of the time she sold her home in 2014. Joanne can claim a deduction for the balance of the point, which is $1,800, on Schedule A in the year of sale, and she will claim a deduction on Schedule A on line 12. That's the specific point where this type of deduction is claimed. Points not reported to you on Form 1098, because clearly in the year of sale on a loan that was taken out a few years back, you're not going to have any document coming that says points were paid. It just doesn't happen. So IRS wants to know that you are claiming a deduction for points that are not on a 1098. Election to capitalize mortgage interest and property taxes on unimproved real property. If you owned unimproved real property, also known as vacant land, you can either deduct mortgage interest and property taxes that you pay on the land as an investment expense, or you can elect to capitalize these costs. And of course, if you deduct taxes and interest, they can go onto the Schedule A. There's a line where you can claim a deduction for taxes paid, and you can also claim a deduction for investment interest paid, but there are limits, especially on the mortgage interest, how much you can deduct as investment interest. So some people choose to capitalize these, and the following costs of owning unimproved land and unproductive real estate can be capitalized: the annual taxes, the mortgage interest, and any other carrying charges such as legal fees or association fees paid in association with the land. But you do need to make an election to capitalize these costs, and you do so by filing a statement with your original return for the year you wish to make the election to capitalize costs. The statement must indicate the item or items that you choose to capitalize. Amounts you received in relation to your property. If you have received financial or tax benefits in relation to your property that were not included in your income in a prior year, you must subtract these items from your basis. And examples of these benefits include rebates received from a manufacturer or seller upon the acquisition of property, forgiven or canceled debt on a loan that the asset secured, insurance reimbursements you received from a casualty or theft losses, and tax deductions that you claim for a casualty or theft loss. All right, so let's move on now to the Uniform Capitalization Rules. This is not a course on the Uniform Capitalization Rules. It is possible we're going to publish one late this year, but for now we're just going to cover some basics that you need to understand about Uniform Capitalization Rules. It's a complex topic, and I'm just going to be touching on it briefly. The Uniform Capitalization Rules require you to add certain costs to basis in certain circumstances. The term capitalize means to include certain expenses in the basis of property you produce or in your inventory costs rather than deducting them as a current expense. Capitalized costs are recovered through deductions for depreciation, amortization, or through cost of goods sold when you sell or otherwise dispose of the property. So let's think a little bit about how you would have costs that you need to capitalize for property that you are producing. Let's just suppose you run a furniture manufacturing company and you've got employees on staff producing furniture. How do you determine how the Uniform Capitalization Rules are going to apply to you? Well, they can be fairly complex, but ultimately the bottom line is, and the purpose of the Uniform Capitalization Rules is to prevent you from claiming deductions for expenses you incur to manufacture items that you have not yet sold. And so you capitalize those costs into the item that you are manufacturing, and when that item is sold, you're going to claim deductions for that through cost of goods sold. In certain situations, you're going to capitalize costs for items that are used for income production, and then depreciation will also be allocated to overhead or to cost of goods sold. There are activities that are subject to these rules, and in particular, farmers have to be concerned with them. But you must use the uniform capitalization rules if you do any of the following in a trade or business or other activity that you carry on for a profit, including production of real or tangible personal property for use in the business or activity, you produce real or tangible personal property for sale to customers, or you acquire property for resale. You are considered to produce property if you construct, build, install, manufacture, develop, improve, create, raise, or grow the property. Tangible personal property includes films, sound recordings, videotapes, and books or other similar property. And under the uniform capitalization rules, you must capitalize all direct costs and an allocable part of most indirect costs that you incur due to your production or resale activities. Any cost that you cannot use to figure the taxable income for any year is not subject to the uniform capitalization rules. Now, there are some exceptions, and the following are not subject to the uniform capitalization rules. Property you produce that you do not use in your trade or business or activity conducted for a profit, or qualified creative expenses that you pay or incur as a freelance, that is, self-employed writer, photographer, or artist, that are otherwise deductible on your tax return. Property you produce under a long-term contract except for certain home construction contracts. Research and experimental expenses allowed as a deduction under Section 174. Costs for personal property acquired for resale if your average annual gross receipts for the 3 previous tax years do not exceed $10 million, and also you do not capitalize certain costs that are not deductible as ordinary operating expenses. And an example of a non-deductible expense is the 50% limit on meal and entertainment expenses. There would be situations where you need to capitalize the costs of meals and entertainment under the uniform capitalization rules, but when you do that, you ultimately would only be allowed to capitalize half those costs due to that 50% limit. Now, for other exceptions to the uniform capitalization rules, you can see Section 1.263A. And for information on special rules that apply to costs incurred in the business of farming, you should refer to the IRS Farmer's Tax Guide, which is publication 225. So why track the basis in personal property? We've been talking about lots of reasons why you would track the basis in business property, and that is, well, you have to. But is there any reason why an individual would track the basis in their personal property? And the answer is absolutely. There's all kinds of reasons to track the basis in personal property because you never know when you're going to sell it or turn it into business use. And since the law does not allow you to claim a deduction for improvements or repairs that you make to your personal property, it is often the case that people don't realize they should keep track of their basis, and they don't. But the 2 important reasons for tracking the basis of personal property are as follows. You should keep accurate records of acquisition costs and the cost of improving your property for when you sell it. If you sell your home or car or other property, you may have a capital gain or a profit from the sale. The law requires you to report and pay tax on profits you make from the sale of your property, including your business, investment, and personal use property. Now, we discussed the sale of investment and personal property in our course called Reporting Capital Gains and Losses, and that's going to be held a week from today. Number 2, you may convert your personal property to business use at some future date, and your cost basis for depreciating personal property that you convert to business is adjusted or increased by amounts that you spend to improve your property. So whether you decide to convert a room in your house for office use of home purposes, or whether you decide to convert your entire house to rental purposes, either way you should be tracking your cost basis in your personal property. And sometimes in the case of stock, well, always in the case of stock, you're ultimately going to be concerned about tracking basis for when you sell it. And so we're going to be talking about stock now. So you calculate your basis in stock in the same way that you calculate your basis in other property. However, sale or disposition of stock is often subject to special treatment, so it is important to be aware of some of the rules that affect the sale of stock. The most confusing aspect for many people is determining the acquisition date and the price that they paid for stock, and how you acquired stock is the first step in solving the problem. Possible methods of acquiring stock include purchase, gift, inheritance, divorce, employee stock purchase plans, employee incentive stock option plans, employee stock purchase plans, employee stock awards, as well as restricted stock units. Now, employee stock options, these 3 categories here, ISOs, ESPPs, RSAs, and RSUs, I'm going to be covering those in this afternoon's class, and that class is called Determining Basis in Employee Stock Options. So I'm not going to be focusing on those today, but we are going to look in general at just a basic stock that you hold that you've purchased or acquired through inheritance or from divorce. If you purchase stock or you get stock through a divorce, you're going to have really essentially a very logical tax basis. Your cost in stock is what you paid for it, and if you acquired your stock in a divorce, your basis in stock that you received from your spouse in a divorce is your spouse's basis. It's very simple. The problem might be getting your ex-spouse to tell you what their basis is. I've certainly run across situations where one spouse has stock that they received from another spouse in a settlement or a property settlement of a divorce, and getting that basis information years after the divorce can be a challenge. But that's a piece of information that has to be figured out. We already talked about the rules for gifts, and we've already talked about the rules for inheritance. So let's move over to the purchase of stock. If you purchased stock, you should keep accurate records of purchase dates and the number of shares of each kind of stock that you bought. Now, most investment companies keep computerized records of your transactions. However, if you switched investment companies, those computerized records may not have followed you to the new company. And actually, in the past, for most of the time I've been doing taxes, they often didn't move from one company to the other. If you were taking your business from one brokerage house to another, the last thing they felt like doing was delivering you the service of helping you leave. So it was up to you, your responsibility to know what your basis in your stock was and get the new firm to know what that was and record that information for you. However, there was no requirement that the new firm track that. And so very often we had situations where I would get brokerage statements, consolidated 1099-B reports with all the subsidiary statements behind them that would show cost basis on a bunch of stock, and then a bunch of stock no basis would be shown at all. And when I interview the client and say, hey, why don't you have basis on this stock? Oh, well, I got that with the old brokerage house. Isn't that on there? I thought they would have recorded that. Oh, they didn't. Gosh, I don't know what to do. How are we going to figure out what that is? And I mean, that's a really good question because if you don't have those records, how do you show what your basis is? So that can be a challenge. But things have changed. As of 2011, this information is required to be tracked, and brokerage firms do need to keep track of what your cost basis is. And cost basis with stock portfolios can require the keeping of a vast amount of data. If you're reinvesting stock, if there's stock splits, if there's stock spinoffs, your broker may be buying and selling stock for you, and you're not even aware it's going on inside your portfolio. So you just get this report with 36 pages of numbers and lines, and somehow from that you're supposed to sort through it and determine what's relevant for your tax return. Well, by and large, that's the reason my clients come to see me, because they can't comprehend this information, and even if they can, they don't want to deal with it. So our ability as tax practitioners to read through these 1099-B statements and apply logical rules for determining basis of assets are really one of the areas that we make our living. At least I do. It's a very big percentage of my business, and so obviously I make sure I understand these rules really well, and I'm very particular about making sure I understand each and every transaction on a 1099-B and whether or not it looks right or wrong. And sometimes I'll run across 1099-Bs still commonly that there is no basis on a stock, or the basis on the stock seems kooky. A few years ago, I had a client come in and he had sold a bunch of stock, and in interviewing him, I determined that he had inherited all the stock. And he'd inherited the stock in 2009 when the market was at its low. It was a bad market. And since inheriting it, the stock had gone up in value. But the brokerage statement that he had actually showed the acquisition costs of his father from whom he'd inherited the stock. And so it was showing these dates of acquisition that were, anywhere from 10 to 20 years in the past. And some of those acquisition costs were quite a bit higher than the fair market value on the date of death. And my client did not like it at all when I told him he couldn't go with that higher basis. And ultimately he said, I'm just going to do it myself. And he walked out and took it with him. It's not at all uncommon, bottom line, for these brokerage statements to have the wrong information on them. And if you are working with a client and they tell you that some or all of the stock on the brokerage statement was inherited, then the thing to do would be to ask, what's the date of death? And see if the basis adjustment on that brokerage statement matches the fair market value of that stock on the date of death. And what I see sometimes happen is if the date of death is, say, August 1st of 2012, if the brokerage statement says that the acquisition date is August 1st, 2012, then in all likelihood they did get that basis adjustment in there. And for our purposes, when we enter acquisition date on the return, we'd actually enter inherit. But at least the date of death would be an accurate date to put in there too. But then you can go to the internet and look up the trade value of that stock on that date and see if there's a match. So that's how I do determinations on those things. So let's take a look at the 1099-B because, of course, 1099-B now provides space for reporting basis, and in the past it did not. Box 1E is used to report cost or other basis, and if the stock was acquired after 2010, there should be a number here. And in addition, if the stock was acquired after 2010, it is deemed to be covered stock, and this box should be checked. Another thing to point out about 1099-B is that for 2014, it has been completely redesigned. Went through a major redesign in 2011, the first year that basis reporting happened, and then they were not quite happy with the design for 2011, so they redesigned it in 2012. And 12 and 13 looked fairly similar, and then 2014 they went through another redesign again. The purpose of the 2014 redesign is to match up the box numbers that appear on the form with the line numbers that appear on Form 8949. So now when you go to the 8949, line 1A is used to enter a description of the property sold. Line 1B is used to enter the date acquired. And so these box numbers on the 1099-B now match up to the 8949. Gifted stock. This is a good one. If you received stock as a gift, you should ask the person who gave you the stock for the records of the original purchase. Your basis when you sell the stock will be calculated in the same fashion as for other gifted assets. That is, your basis for calculating loss or gain on the sale of gifted stock will depend on whether the fair market value of the stock is less than, equal to, or greater than the donor's adjusted basis at the time of the gift. Now, if the person or entity that gave you the stock does not have accurate records, you should try to get at least an accurate purchase date. You can consult periodicals and other reference sources to determine the fair market value of a particular type of stock that was issued, as long as you have the following information: the date that was purchased, the number of shares that were purchased, the name of the company or the mutual fund, the number of stock splits that have occurred since the stock was issued, and the number and valuations of any shares allocated to a new spin-off company. Quite frankly, one of the items of information that you probably could get when stock is gifted is what they paid for it, but they may not know what they paid per share. For example, you could have a friend or a relative that gives you stock valued at $10,000. Let's suppose it's in Comcast Cable. Well, when did Comcast Cable come into business? Was it in business at the time they purchased that stock? Do they remember how many shares they bought? Has Comcast had any splits or spin-offs since then? Maybe there's been mergers. Those big companies often do all of those things. But maybe the person that gives you the stock actually remembers how much they paid. And if they gave you all of the stock they had and they remembered how much they paid, you could ultimately go back in time and figure out what the cost per share was. Now, there was a fun situation I dealt with many years ago. I had a man come in to see me, and he had sold stock in a company called Pittsburgh Steel. And how he acquired the stock was his grandpa bought it for him when he was born. He has no memory of his grandpa going out and buying this stock. It's all based on testimony. But the fact of the matter was that when he was born, his grandfather, in honor of that or in commemoration of his birth, went out and bought stock in Pittsburgh Steel and gave it to him. And obviously it was in the hands of his parents until he was old enough to take control of it himself as a man. And then he finally decided to start selling some of it. And he was making some pretty good money. This stock was worth a lot of money, and so the 1099-Bs he was bringing in were showing a substantial sum, and he had no record whatsoever of any cost basis in it. So ultimately, the only piece of information I had on which to gain the information I needed was to use his birth date, the date he was born, as a likely acquisition date. And what did Pittsburgh stock trade for back then? And how many shares did he have today? Well, by taking the number of shares he had today and factoring for any stock splits, we were able to go back in time to arrive at an actual cost that his grandpa would have had to have paid to acquire that stock way back then. And at the time I was doing this, we didn't even have the ability to look this stuff up on the Internet. This was back in the mid-90s, and it just wasn't possible for us to look this up on the Internet. But I ultimately just picked up the phone and called Pittsburgh Steel and got through to a person there who was able to give me these prices and information on stock splits, and we were off and going, and that was what we went with. And that was all we could go with, but it was reasonable. The methodology used to acquire that cost basis was reasonable. Now, these days it is easier to look up stock basis or to look up pricing of stock on certain dates. And you can do that by visiting bigcharts.com. I have a link in the manual here for you. But I'm going to take you to bigcharts.com just for a minute here. There's not a tax season that goes by where I don't visit this website frequently. So on bigcharts.com, you are given an opportunity to research information. And you'll see if we float across here, kind of where my finger is, if we float across, we'll come to a little header that says historical quotes. If I click on that, it takes me to this page. And the page is defaulting to Microsoft, which is the abbreviation MSFT. And I would tell you that when I come to this site, I have to know what the symbol is for the stock that I'm looking up. And sometimes I'm having to use Google to search for the symbol if the brokerage report I'm looking at doesn't already show me what it is. Often the brokerage report does tell me what the symbol is, but often it doesn't. So once I've determined what the symbol is, I enter the symbol. And you can see here that Big Charts is telling us that on 5/26 of 2010, Microsoft was selling for the amounts that you see here. We have a closed price, we have an open price, we have a high, and we have a low. When you're dealing with inherited stock, the high and low is very important because for inherited stock, the basis in the inherited stock is going to be the average of the high and the low for the day. So you take the high of the day, $26.60.5, and add to that the low of the day, $24.56. And then divide that by 2, and the resulting average of those two numbers becomes the basis for the inherited stock. The other thing to look for is splits, and you can see here that in the range that we're looking at that there are no splits, but we could go back in time a ways, and I'm just going to go back, I don't know, to 2005. How does that sound? So we're going to go 01/15 of 2005. And see what I get. So it's taken us back further in time, and I'm still not seeing any splits, but that does make me suspicious because it's possible we haven't had any splits since then, but I'm suspicious there could have been. So sometimes when I'm on Big Charts, I may not get all of the information I want, and I'll go to the website of the company directly. The search engine I type when I'm looking for a website is shareholder services and then the name of the corporation, or the name of the corporation followed by the word shareholder services. Typically when you do that, it's going to give you, in the Google search listing, a place to go to get this type of information that you need. Now, the beauty of Big Charts is it does allow you to look up stock values. The negative of Big Charts is if you go back far enough in time, you may not be able to look up the stock that you want. So if I, for example, enter 01/21 of, let's just say 1998, let's see if it's going to take me back that far. Looks like it did, but there is a limit of how far it will take me. Oh, but we do get a split this time. There's a split adjusted price right here. 8-for-1. Wow, 8-for-1 split. So way back here in 1998, Microsoft was trading at it for a number higher than what it's showing here. And the reason that it's giving this low number of 17,125 is that there has been an 8-for-1 split since then. So these are important things to be looking up. But there eventually is a limit where when I'm looking up on Big Charts, it just doesn't go back in time that far. And if you want to get more information than that out of Big Charts, you have to subscribe and pay a user fee. But you can still get lots of useful information without having to do that. That's a brief look at Big Charts, and of course Big Charts comes in totally handy when you're trying to look up the basis of inherited stock. You simply go there, you enter the symbol for the stock, you enter the date of death, you find the high, you find the low, you average the two, and presto, you're done. So let's talk now a little bit about dual basis assets. That adds another whole level of complexity to basis of assets. And I have a completely other course that I cover the alternative minimum tax in, and we look more at figuring your basis or your dual basis in an asset there. But we're going to talk about it a little bit today as well, and how alternative minimum tax can have a tax basis all its own. There are two tax codes that are operating simultaneously: the regular tax, which is the tax that we see, live, and breathe as tax professionals, and then in the background, kind of off to the side, is this alternative minimum tax. And because the AMT is affecting increasingly large numbers of filers, it is important to be able to determine whether an alternate basis will be affecting an asset that was sold for purposes of figuring alternative minimum tax. Now, for most taxpayers, cost basis for an asset is generally the purchase price plus or minus acquisition costs and depreciation, etc. But some items that cause an adjustment to basis under the regular tax receive different treatment under the alternative minimum tax. And two common examples of situations where an asset may have a different basis under the AMT than it does under the regular tax include depreciation deductions and incentive stock options. So let's look at depreciation deductions first. Depreciation deductions under the AMT can be less than the regular tax, and if you claimed a smaller depreciation deduction under the AMT than under the regular tax, you will have a higher adjusted basis under the AMT than you do under the regular tax. And here is an example of what I mean. And if you spend any time studying and thinking about depreciation schedules, you're probably used to seeing this far column on the depreciation schedule that says AMT adjustment. The AMT adjustment is a number that ultimately is going to be carrying to the 6251. It's kind of important, but if your client isn't paying alternative minimum tax and you're not generating a 6251, you may not even be aware of what's going on or what the purpose of that number is. So we're going to be talking a little bit about that here. Billy has been depreciating a computer network, and he paid $20,000 for the network and has claimed depreciation deductions of $12,000 under the regular tax, leaving him with an adjusted basis of $8,000. Now, during the same time frame, Billy's AMT depreciation deductions for that same computer network were $11,000, leaving him with an AMT adjusted basis of $9,000. So under the regular tax, his basis is $8,000, and under the alternative minimum tax, his basis is $9,000. The acquisition cost for the asset is the same in either case, but the amount of depreciation allowed over time is less under the AMT than it is under the regular tax. And so this is one of the more common ways or reasons why you would have a difference in basis under AMT than you do under the regular tax. The next reason why there can be a difference, the next most common reason, has to do with incentive in stock options. An important circumstance that can create a dual basis in an asset is the exercise of an incentive stock option. And under the rules for AMT, an adjustment reflecting the difference between the fair market value and the exercise price of the option must be included in AMT income calculations for the year the exercise occurred. And then you include the difference between the fair market value and the exercise price in AMT income. So what happens is when you purchase incentive stock options, you are allowed to purchase them at less than their cost. And under the regular tax, there's no tax consequence until you sell them. So the act of buying the incentive stock options for less than their value does not create income under the regular tax. But under alternative minimum tax, the rule is if you purchase stock for less than it's worth, then the difference between what you pay for it and what it's worth has to be included in your alternative minimum taxable income. And in certain cases, if there's enough of it there, it can trigger AMT and cause you to pay AMT on money that you haven't made. And if you pay tax on money you haven't made, then you ultimately have paid alternative minimum tax on what we refer to as phantom income. So because of the rules about including the spread or difference between what the stock is worth and what you pay for it when you buy it, you can have a different basis under AMT than you do under the regular tax. And here is another example. During the year, Billy exercised ISOs in Jack Inc. And at the time of the exercise, Jack Inc. stock was trading for $80 per share. Billy exercised an incentive stock option to purchase 500 shares at $30 per share. For AMT purposes, he reports an adjustment of $25,000 or $50 per share. The result is that he has a basis in Jack Inc. of $30 per share for regular purposes and $80 a share for AMT purposes. So let's see what happens when you sell a dual basis asset. The act of buying an asset that triggers AMT is going to create a tax consequence under the regular tax, but when you turn around and sell it, now you have to worry about what's my basis under the regular tax and also what is my different or alternate basis under the alternative minimum tax. So the sale of a dual basis asset, such as an ISO, or assets that were affected by AMT depreciation deductions or adjustments, makes it necessary to report the difference between the regular tax gain or loss and the AMT gain or loss as an adjustment item on Form 6251. If the AMT basis of an asset is higher, as is usually the case, then the difference is reported as a negative adjustment on Form 6251. The result may be to reduce the amount of AMT owed or to increase the amount of AMT credit allowed for the year. Now, in the year that an AMT adjustment is made, so that additional money is included in income with respect to the purchase of an ISO or with respect to a disallowance of a certain amount of depreciation on a depreciable asset, you're also going to have an adjustment on 6251. So what happens under the AMT with certain deferral type items like depreciation and incentive stock options is that in the year that a deduction is disallowed or a form of income is forced to be recognized, there will be an income line for that on the 6251 for the year that income is recognized under AMT. And then in the year you sell, you're going to offset that earlier income reporting by any difference that you're now allowed to deduct for the alternative minimum tax adjustment. And so here is an example on how that would work. In the preceding example, Billy held 500 shares of ISO stock at a basis of $30 per share for regular purposes and $80 a share for AMT purposes. If he sells the stock for $100 per share and has no other capital gains or losses, he should report a negative adjustment of $50 per share on Form 6251. If Billy is required to pay AMT in the year of sale, this adjustment will reduce his alternative minimum tax liability. And if Billy does not have to pay alternative minimum tax in the year of sale, the adjustment may make it possible for him to claim an AMT credit in that year. And in fact, he may also have been able to claim a partial credit or full credit for his prior year minimum tax in earlier years as well. The difference between the regular tax gain or loss and the AMT gain or loss may be different than the adjustment made, though, when the option was exercised. So the added nastiness of the alternative minimum tax is in an earlier year you may have been forced to include a whole bunch of income, and then in the year you sell, you're not allowed to claim the same amount of deduction. It's a rotten deal. But let's see how that might happen for Billy. We have a purchase price of $15,000 under both the regular tax and the alternative minimum tax, but the fair market value of the stock caused him to have to include $25,000 in his income when he exercised his options and bought those shares. So once he added $25,000 to his income under the alternative minimum tax, that increased his basis under the AMT to $40,000, leaving his basis under the regular tax still at $15,000. Now, in the year he sells under both the regular tax and the alternative minimum tax, the selling price is the same, $50,000. He then looks to see what his profit is. Well, if you take $15,000 from $50,000, the difference in those numbers is $35,000. So under the regular tax, he has a profit of $35,000. But under the alternative minimum tax, you're going to subtract $40,000 from $50,000, and you're left with a profit of $10,000. So the capital gain or loss to be reported in Billy's case is going to be $35,000 under the regular tax and only $10,000 under the AMT. And this $25,000 difference you see here will be an adjustment item carried to Form 6251. Let's look at another situation. In this one, we have Sally, who exercised shares of ISO stock in 2012, and they had a spread or a difference between the exercise price and the fair market value on the date of the exercise of $60,000. Now, the share price of the stock was $50 per share, and the fair market value was $110 per share. So she exercises 1,000 shares that have a spread of $60, and that's why she has to include $60,000 as alternative minimum taxable income in her income in 2012. During the period that she held the stock, its value unfortunately declined. It declined from a high of $110 per share in 2012 down to a low of $90 per share in 2014 when she finally sold. Now, when she sold it, though, she sold it under the regular tax for a profit. She was still able to turn a profit under the regular tax, but under the AMT, she has a loss of $20,000. But the loss limitations under the AMT are the same as they are under the regular tax, so Sally's loss under the AMT is limited to only $3,000 in the current year, unless she has other capital gains to absorb the loss. The difference between Sally's regular tax gain or loss, which is a gain of $40,000, and her current year allowable AMT gain or loss, which is a loss of $3,000, is $43,000. And so she will enter $43,000 as an adjustment item on Form 6251, line 17. She will also have an AMT capital loss carry forward of $17,000, which can be used in AMT calculations in future years. So here's the table I put together for the difference in tax treatment for Sally. We have a purchase price of $50,000. It is the same under the regular and under the alternative minimum tax. The realized gain that is reported on purchase under the regular tax is 0, but under the AMT it is 60. Thus, her basis under the regular tax is 50, while her basis under the AMT is 110. When she sells for 90, her profit under the regular tax is $40,000, but she has a loss of $20,000 under the AMT. So we can see here that the income amount of 60 that she had to report in 2012 should, if all was fair, be offset by this loss of 60 in the year of sale, or this difference of 60 in the year of sale. But unfortunately, what she's not going to be able to do is claim all 60 as an adjustment item. Instead, she's going to be allowed to claim the profit that does not exist under the AMT, which is 40, plus an additional $3,000 of loss that does exist under the AMT. So she takes 40 plus 3 and gets that $43,000 adjustment item for purposes of alternative minimum tax, and then this difference of $17,000 will carry forward to the next year. I did just quickly fill out a 6251 for you so you could see what was going on with Sally. I had to give her some income, so I decided her starting line number 1 would be $200,000. And I also decided to give her some adjustments for taxes that she paid on the Schedule A. AMT doesn't allow you to claim a deduction for taxes paid, so I had to add those into her income. And then down on line 17, this is where I've entered the adjustment between the regular tax and the alternative minimum tax on the profit, or in this case, loss on the disposition of property. And we arrive at line 28, which is her alternative minimum taxable income. So this illustration assumes that the amount on Sally's Form 1040, line 41, which is her adjusted gross income after subtracting itemized deductions, is $200,000, and that taxes deducted on Schedule A totaled $30,000. Taxes deducted on Schedule A are taxable under the AMT. She will have to increase her alternative minimum taxable income by that $30,000. Also, net gain reported under the regular tax is $40,000. Net loss allowed under AMT is limited to $3,000, and that's where we end up with that $43,000 adjustment item. So that's it. We've come to the end of today's class on the basis of assets, so I hope you've enjoyed it. I'm going to give you the second password of the day so that you can take your password test. So thanks for participating in today's class. I hope to see you again soon. Password number 2 is Army Bay. ARMYBAY. Army Bay. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.